Welcome to the Prosperity Health GP series. As specialist advisors to the Medico sector, we're acutely aware that our clients are frequently time poor and not available during business hours. So what we've done is put together a series of short videos based on the common queries that we get from our clients and dealing in ways in which they can better manage their practices and better manage their wealth and finances. My name is Gavin Fernando and I'm one of the wealth advisors at Prosperity Health. Today I'll be presenting to you on the topic of investing, and in particular, three areas. Firstly, the power of accumulation. Secondly, why not all returns are equal, even if they look so. And thirdly, upon matching your investments to your goals. Apart from the investment we make in our career and in our practices and maybe in our home, the most significant stake we're going to make is in investing for our future and for our goals, be it short term for an overseas holiday next year or even longer term for retirement. Firstly, the importance of accumulation. The most successful way to build wealth is to accumulate it, and the most successful way to accumulate it is to start early and save often. Consider two savings and investment scenarios. Firstly, saving $5,000 a year over a 20-year period and obtaining an investment return of 5%. And secondly, saving $10,000 a year over a 10-year period and getting a return of 10% per annum. In considering the scenarios, I will be ignoring investment risk. It's also a model, so it's simply to demonstrate a point. It's not predictive of the results that any portfolio will get in any way, shape or form. So you can see, even though the same amount of capital is invested, that is $100,000, and even though return on the second scenario is double that of the first scenario, the amount that the investor has at the end of the period is better on the slower and lower earning return portfolio. So how can this be? Well, it's a function of two things. Firstly, the power of regularly accumulating capital, and secondly, the power of compound earnings on that capital. Next, we'll look at the fallacy of expressing investment returns in absolute terms only. Not all returns are equal, even if they look the same. The press regularly reports on returns in dollar and percentage terms, but what attracts much less reporting is investment risk. It is impossible to make a valid judgment on returns without considering risk. There are many risks in accumulating and building wealth, from concentration risk to counterparty risk, and even the risk of you outliving your capital. What I want to discuss here is the risk of investment volatility, or put another way, the variance from the return that you might expect from your investment. Consider the example here. The returns are identical, at least in an average sense, over a 3-year period. In this scenario, again, a model, not a prediction, the returns in Portfolio B are much less volatile than those in Portfolio A. And by that I mean the highs and the lows in the various years on Portfolio B are constrained around a much tighter bandwidth than those in Portfolio A. So is volatility important? Yes. Even though the returns are identical in each portfolio, you'll see that the lower value portfolio produces a better dollar return over the 3-year period. So it follows for us that it's important to consider volatility when measuring against return. And that's true even when you're looking at a return of, say, plus 18% compared with plus 11%, as in the first year of this scenario. Managing downside risk, even at the expense of giving away some of the upside, usually pays off in the long run. Portfolio A is symbolic of an index approach, sometimes known as passive investing, where we simply take the index of whatever market it is that we're trying to invest in. Portfolio B is symbolic of a successful active management approach, where we select certain sectors and certain stocks and have higher or lower weightings to those sectors and stocks, with the idea of trying to remove those variabilities or volatilities. Portfolio A is symbolic of an index or passive approach. Portfolio B is representative of a successful active management approach, where certain sectors and stocks are given more or less weight in order to manage the volatility. Finally, we look at matching your investments to the goals for which you are investing for. Consider the previous portfolio examples. If our investment goal is only 1 year away, then neither of those portfolios is suitable. Similarly, for longer term investing, the vagaries of the share market are not as important over the period of the investment. A higher return, with some constrained volatility, will usually give us a better result in the long run. We can expect and cope with some volatility along the way. As a general rule, cash and shorter term deposits are more suited to short term goals, and share market or growth investments are more suited to longer term goals. It's also important to consider your investment risk temperament, but that's a discussion for another day. Your Prosperity Health Wealth Manager can work through the various risk profiles and determine the most appropriate one for you. So in summary, for effective accumulation of wealth, start early and save regularly. When considering your investment returns, always look at the volatility of those returns, not just the absolute figure as well. And finally, match your investment goals. And finally, match your investments to the goals for which you're investing for. It's much more important to have access to the capital when you need it than getting a better return on that capital. I hope you enjoyed this episode of the Prosperity Health GP series. For more information, contact your Prosperity Health advisor or visit us at www.prosperityhealth.com.au.